What up guys, it's Thanos here. Since the beginning of 2021, that's about 6 months now, I've been trying to build an ETF only portfolio. And that's not because I don't like individual stocks. On the contrary, I love picking and analyzing stocks, and actually I have a portfolio only with stocks. However, the recent volatility in the market got me thinking about how it would be best for me to allocate any new money. Of course, I'm not going to sell my stocks, I rarely sell anyway, but I just wanted to experiment. What I want to say here is that this specific portfolio is not going to be classic index ETF like the S&P 500, Nasdaq and such. The goal here is to try and find specific sectors of the market which I believe are going to be profitable in the next 20 years or so. With all that said, I do not want to bore you with more details about my whole strategy, so let's go straight to see some of those ETFs that can make you richer in the second half of 2021 and beyond. The first one I want to talk about is the Globalx Lithium and Battery Tech ETF, which has the ticker symbol LIT. LIT offers an opportunity to invest in the global lithium and battery market while diversifying individual risk. It is a market cap weighted index that tracks 20 to 40 companies engaging in global mining and lithium extraction for the production of battery cells. Therefore, the fund created by Globalx gives concentrated exposure to the industry with a micro cap tilt. It has an average weighted market cap of 76 billion and an expense ratio of 0.75%, representing the initial cost when investing. It also pays a yearly dividend of 0.6%. The ETF is very well diversified. It includes companies from 10 different countries, concentrating mostly on China and the United States. Its holdings, as you can see from the table, consist of companies that are part of the full lithium cycle, from mining and refining the metal through battery production. Now, battery producers and electric vehicle manufacturers had a strong year in 2020 and outperformed the broader market as shares saw an unprecedented demand, especially from the retail sector. However, along with most of the technology market, shares dipped substantially from all-time highs and are now down by more than 20%. Yet, when looking at the immense growth of the lithium-ion battery market, it should recover in the long term. Global demand for lithium and complementing batteries is set to increase drastically due to the rapid adoption of electric vehicles in the coming decades. In fact, over 120 million electric cars are expected to drive on global roads by 2030, up from just 5 million in 2020. Unsurprisingly, the global lithium-ion battery market size is expanding to 129 billion by 2027, representing a CAGR of 18%. I believe LIT ETF is well positioned to capture this growth by including the most promising companies in the space of the biggest nation in the world. However, the past performance points at high volatility, so any long-term gain will likely come with sharp pullbacks from time to time. The second one is the Globalx Video Games and Esports ETF. Hero is a great vehicle to gain exposure to the diverse world of gaming. The ETF has outperformed its peers in recent years and has some very strong stocks within its top holdings. I expect the gaming sector to continue to be a high growth market, especially in areas like Asia and India. The Hero is an ETF that offers exposure to the gaming sector. This is a broad definition, and as such, what we see in the Hero is stocks in various sectors but which are all in some way tied to gaming. The charts above show the top 10 holdings in this ETF and also the geographic distribution. As we can see, the top 10 stocks in this fund make about 54% of the total investment. The largest holding is CE Ltd, a company which has gone on a tear this last year. Suffice to say, CE's video games have performed very well, but the company is also an e-commerce and payment giant in Southeast Asia. The ETF also provides exposure to the semiconductor industry by owning Nvidia Corporation. Nvidia makes GPUs that are necessary to run video games. Then we have more pure gaming companies such as Nintendo, Activision Blizzard and EA. The Hero is, in my opinion, an ETF worth holding. The gaming sector provides exposure to a variety of technology companies that could do very well in the future. First off, gaming companies are beginning to leverage their earning potential much better. League of Legends and Fortnite paved the way for a business model which is much more efficient at targeting the gaming demand. The main idea is that rather than create one price point, you allow users to spend as much money as they want. The key is that, when possible, companies should allow people to decide how much they want to spend. This gives companies the ability to target the whole demand curve. Games like Fortnite are free to play, but the super fans spend high amounts of money on in-game purchases. This trend will continue to favor gaming companies. Now, the other thing that I love about the gaming sector and this ETF too is that both are well positioned to capture high growth markets in China, Southeast Asia, and even India. The latter had a growth rate of 165% between 2016 to 2018 in the number of online gamers. These gaming companies will do well in these markets as they have little competition and can easily compete even if they are based abroad. Expenditure on gaming will grow as the middle class in India and China does too. The other great thing about this ETF is that it is resilient. Gaming companies have done well in the coronavirus pandemic. While I expect and hope the worst is behind us, it is nice to have a hedge like this in your portfolio. Something that might outperform if a situation like this were to happen again. But I believe the gaming sector is also resilient in hard times. Gaming can be seen as a low-cost form of entertainment when compared to traveling or going out. The gaming sector is poised for continued growth in the future, and I believe investors will do well to get some exposure to it. The hero has an excellent track record and is well diversified in terms of companies and geography, as well as having a low expense ratio. The third exchange-traded fund is the Advisor Shares Pure US Cannabis ETF. Marijuana for medicinal use has been legalized in 17 states. Another 10 have approved it for medical usage, but their decriminalization laws are all mixed up. 19 states have permitted its medicinal use but have not decriminalized it, while its usage remains illegal in 4 states. Recently, the House have approved a bill that makes the US banking system less cumbersome for cannabis companies. President Biden is not saying much on completely decriminalizing cannabis, but he did say in February 2021 that his administration would pursue it. Now, the Reddit gang has also gotten into the act and has started pumping up pot stocks. However, the Redditors, though they can take any stock to the moon, they are not the reason for my bullish view on the industry. I believe that cannabis medicinal use will be decriminalized in the long run, and that most companies in the sector will gradually perform. At first glance, the individual stocks in MSOS ETF appear overvalued. However, valuations are a story of two tales, which is why I zoomed out the time frame to view the valuations from a different perspective. Nearly all holdings in the ETF trade at around 10 times price to sales, which is modestly high considering most companies are yet to turn a profit. On the other hand, nearly all companies in the ETF are growing sales by 100% annually and are backed by a 100 billion market that is growing at a compound annual growth rate of 15%. Moreover, historically, it can be observed that various cannabis stocks were once trading at 20 to 30 times or even 50 times sales, so on a relative basis, valuations are nowhere near all-time highs. Frankly, historical prices do not predict future prices, but it does demonstrate high volatility, which can be an advantage as seen in the AMC's latest short squeeze. Overall, it can be observed that the ETF's top 10 holdings include 1 overvalued stock and 2 undervalued companies with more potential upside. Here, Innovative Industrial Properties trades at almost 30 times sales, although it should be noted that it is a profitable firm, thus holding less risk. On the other hand, Cresco Labs and Columbia Care appear undervalued at just 4.4 times and 6.2 times sales respectively. Therefore, it is great that the ETF diversifies among both overvalued and undervalued stocks while increasing the chance of a breakout stock. Overall, Advisor Shares Pure US Cannabis ETF is an attractive investment opportunity to include exposure in a portfolio to the cannabis market. Political macro factors are increasingly turning in favor of the cannabis industry, and we should expect more states to legalize recreational marijuana use in the distant future. Nonetheless, various risk factors such as lower revenue growth or new political restrictions on the cannabis market could negatively influence the stocks, which are already trading at premium valuations. Nevertheless, investors with a certain level of risk tolerance could mightily be rewarded in a few years. So that's it guys, my 3 favorite ETFs to buy right now. If you found this video useful, make sure you hit that like button and subscribe to my channel for more. Until next time, stay safe.